Hi, I'm John Vucicevic, and this is Rob Lambert's AssetProtectionTraining.com. Today we're going to talk about the 401k basics and how it affects the employee. Like all plans that are designed to save money for retirement, 401k is just another one of those. It's a very popular plan, and most people know what a 401k is. I think few understand how it actually works. So that's what this program here is designed to do, is to give you the basics as to what you have available to you. It's an individual retirement agreement, and it's employer sponsored. So the people that you work for created the plan and put all the stuff in there that you can invest in. Okay, it's a personal savings plan, just like all other qualified money that's out there. This one, however, is a defined contribution. So between you and your employer, there are rules that dictate how much you can put into the program. So it doesn't say what the benefit's going to be, but it does tell you what the contribution's going to be. So why would you invest in a 401k anyway? And it's because of tax benefits. 401k is the section of the Internal Revenue Code that talks about these kinds of dollars. So it's the house, if you will, that your money lives in, that the IRS looks at as a tax benefit. So you get to tax deduct the dollars that are put in there. In addition to the deduction, you also get all the interest in there that's deferred. So you don't get to deduct any of the interest, you don't get to use it until later, but it doesn't have to get taxed until you actually take it out. So those are two big reasons why you would put money into the 401k. Banks, mutual fund companies, brokerage houses, other financial institutions, as well as insurance companies will provide the underlying tools inside the 401k that will offer you the opportunity to earn interest. Your employer decides what investments are going to be in this plan. They can decide whether they have stocks of the corporation in there. They can decide not to. They can decide if it's only going to be mutual funds and what mutual fund families are going to be part of the plan. They can decide to have it an open architecture. All of that's driven by a summary plan description, which is created once these decisions are made. That summary plan description is presented to you when you join the firm for employment. You get your health benefits, you get your conduct, how you're supposed to act at work, where you can smoke if you're a smoker. You get all that information and what your expectations are. You also get a summary plan description of the 401k, and then you can decide to participate or not participate. This right here defines all the rules that the employer has set up, complying with the IRS rule book with respect to their specific plan. An employer can also opt to have a safe harbor inside their plan. This is an option that's created to allow the employer to deduct more money. Now, this is good for you because if the employer makes a contribution, and it is discretionary on their part, but if they make a contribution, it's 100% vested by you, and they get a bigger deduction, but it goes into your account. So there's a couple rules right there, and again, it's just additional money that the employer can put in to the 401k for your benefit. All right, in 2011, if you're under 50 and a half, you can drop in $16,500 into your 401k and deduct every one of those pennies or dollars from your tax returns. The nice thing about 401ks is every time you make a contribution, it's deducted right away. So every 2 weeks, let's say if you get paid, you make $100 and you put in $10, you're only going to get taxed on that $90. And that's going to carry on through as long as you're participating in the plan. If you're over 50, you can add $5,500 to that $16,500 for a total of $22,000, and it's called a catch-up provision, and they allow those older folks to make additional contributions to their 401k to make sure they have enough money at retirement. We're close to 2012, so I wanted to throw this number out there for you, but in 2012, the maximum contribution in any 401k goes up, as it does every year, to $17,000. Under age 50, your employer, if they have a safe harbor plan, here's the rules, they can put up to 100% of your pay into a 401k as a contribution on your behalf. So let's go back to that example. If you made $165,000 last year, the employer could not put all $165,000 into the plan for you. They would cap that out. It's 100% of your earnings, not to exceed $49,000. And that does include that $5,500 of catch-up provision. So those of you over 50 and a half don't get an extra benefit for catch-up if the employer is contributing. 59 and a half rule applies. What this means is that if you try to get money out of your 401k before 59 and a half, you're going to get not only taxed on those dollars because they've never been taxed, you're going to get penalized as well of 10%. So that can be a substantial decrease with respects to what you end up with taking these dollars out. Examples of where it would apply is if you took your money out and wanted to buy a car or put your kid through college, something of that nature. There are ways to get money out of the 401k. It's beyond the scope of this particular lesson, and we will address them in later sessions here. But for right now, any basic things that you want to spend this money on other than retirement is going to get penalized 10% plus taxed at whatever tax rate you are at the time you take the distribution out. At 70 and a half, you have to take money out. So at 70 and a half, there's a required minimum distribution. That's the littlest or smallest amount of money that needs to be forced out or is forced out of your 401k, and that happens at age 70 and a half. Sometimes people retire earlier and take it out earlier, but at 70 and a half, if you have not yet done so, you're going to be forced to do it based on the IRS tables. With respects to withdrawing money from the IRA, there are a few hardship withdrawal provisions inherent inside the programs that allow you to get money out. You can find all of that in your plan description, but there are very, very few hardships that qualify for withdrawals from the 401k without penalty or tax. My name is John Wojciechowicz, Rob Lambert's AssetProtectionTraining.com website. Talk to you soon.